There are signs China's economy is slumping amid its trade war with the U.S. Last month, the country's retail sales grew at their weakest pace in 15 years, and industrial output rose the least in nearly 3 years. So is this a symptom of U.S. President Trump's tariffs or something else? Brett House is the deputy chief economist at Scotiabank, and he joins us from Toronto. Hi, Mr. House. Great to see you again.
Good evening.
So let me start there in the picture of China's economy. What do you read into some of the newest numbers coming out?
Well, we've long anticipated a slowdown in the Chinese economy because it's been a very capital-intensive, investment-driven growth story in China for many years. And just as we've seen in other countries, whether it's the planned economies of the former Soviet Union or the East Asian tigers that did very well through the 80s and 90s, that model of growth eventually hits diminishing returns. And China's been in the process of some time of trying to pivot to a more consumption and service-oriented economy that is driven more by domestic demand rather than by servicing export markets through that investment-led growth. And so you're seeing, some of that transition taking place right now, where growth is slowing on the old model before the new model is really taking hold. And amongst China hands, such as my colleague Tuli Mikuli, they've been anticipating the growth slowdown that we've seen in recent quarters and anticipate it will continue through into the next couple of years.
Was it accelerated, or has it been accelerated at all by the so-called trade war with the U.S. that we see unfolding and has been for a number of months now?
Yeah, I think it wouldn't be the first time that a certain tweeter has taken credit for things that are well beyond the forces that he is able to control. No, I don't think so. The impact of the trade spat between the U.S. and China has had very little impact on Chinese growth at this point. Similarly, it's had very little impact on U.S. growth to this point. It really would require a big step up in those trade tensions and significantly more tariffs in order to have a meaningful dent in growth in either country.
That's interesting. What's your read of the sort of, how would you characterize that dispute right now? I mean, obviously we're talking about this because the trade war has seemingly had an impact on our diplomatic relations with China vis-a-vis the arrest of the Huawei CFO and the reaction from China to it. How would you characterize the dispute right now with the U.S.?
Well, it's technically in a truce following the dinner between Trump and Xi at the G20 in Buenos Aires about a week and a bit ago. But I think that's actually indicative of the White House wanting an off-ramp from this dispute, because the first $50 billion in U.S. imports from China that were hit with 25% tariffs around June of this year, and then the second tranche of imports that are now being taxed at a 10% duty rate, and that tranche amounts to about $200 billion. We are now seeing the move into Chinese imports that are dominated more intensively by consumer goods, the Galaxies, the iPads, the iPhones that American consumers love and are a staple of gift giving around the holiday season. And if they were to go up by a substantial price hike as a result of a tariff going into the 2020 election season, I think the White House would see some of its re-election prospects dented. And so, despite the rhetoric, either on Twitter or coming from the White House directly, I think the White House entirely wants to see the situation cooled, and it doesn't want to follow through on further tariff hikes because it knows it would hit the households that are right at the core of its base.
Let me bring it back home to Canada. We learned, as we said off the top there, that Canada Goose is delaying opening a store in China as a result of the current dispute. Do you think other Canadian companies are vulnerable?
Well, individual companies are certainly vulnerable. That said, China accounts for less than about 5% of our exports at present. Although we've talked a good game for a long time about diversifying our trading relationships with the world, about 3/4 of our trade still goes to the United States, and we really haven't diversified our trade to Asia to the extent that we have long wanted to do so. So unfortunately, or perversely fortunately right now, we're in a situation where China doesn't account for a major share of our exports, but for specific companies, as you highlighted with Canada Goose, the potential for short-term pain right now as a result of a disruption in trading relationships with China are really substantial.
What about specific sectors? And yesterday we spoke, for example, with someone who represents the agri-food sector, and they were particularly worried when it comes to soy and canola. Where would you be looking to see, for example, if China did take some retaliatory action against our economy, where would you be looking to?
Well, our exports to China are dominated by oil and gas, wood and pulp and paper products, and agri-food products, and the agri-food business more broadly. So those are the three sectors that are likely to be most affected should China want to take some kind of retaliatory trade measure against us. Of course, unless those retaliatory measures are grounded in the rules of the WTO, those would technically be legal, and they would potentially trigger the tariffs that are imposed being provided with some kind of compensatory payment later in the future. But sometimes that could be so far in the future that a company is potentially hit bankruptcy in the interim. So whatever help may come in through a WTO action is too late in the game to be helpful for the companies that are affected. That said, China needs most of the commodities that we export, and it is not in a position to substitute them clearly from other suppliers over the longer term, but it may, rather than raising tariffs, just make the importation process slightly more onerous for Canadian companies in the short term.
You mentioned that right now it accounts for 5% of our trade, but obviously you know as well as I do that there has been a lot of discussion, especially recently since the new NAFTA, the beginning of the new NAFTA negotiations, but even prior to that, about utilizing China, taking advantage of the potential for that market. Do you think, how worried should we be about this dispute potentially impacting the future prospects for trade with China?
Well, it's certainly likely to have an impact on the discussions that have been used about a sectoral approach to a free trade arrangement with China. It also, may have a longer-term impact on the development of markets for Canadian products. China consumes about half of the world's annual output of metals and minerals every year. It obviously has a big impact on global prices for those commodities, and over longer term, it may be able to develop alternative sources should this dispute go on for a significant period of time.
All right, thank you so much, Mr. House.
Thank you.